Welcome back to Kitco News. Now, the gold market is trying to find its footing, consolidating just under $4,000 an ounce on the spot side, just above $4,000 at the time of this taping. Now, that was after a historic run was met with that brutal correction, the worst single-day drop for the metal since 2013. But while traders debate the short-term direction, a much more profound shift is happening in the capital markets. Now, we know that central banks have been the driving force here, reportedly stockpiling over 1,000 tons of gold this year alone. But now there's a new, kind of completely new, disruptive source of capital is targeting the producers directly. Now, it's coming from the crypto world, and our guest today is at the absolute epicenter of that collision. Let's welcome back our friend, CEO and president of Metella Royalty and Streaming, Brett Heath. Good to see you. A very pivotal moment for the industry here. Thanks for making the time.
Yeah, thanks for having me, Jeremy.
I got to ask you about that, the landscape here for royalty and the streaming sector itself, because in a world with $4,000 gold, I mean, the business model is a cash flow machine. You and I have talked about this before. The majors, Nevada, Wheaton, are reporting spectacular all-time record quarters. From the perspective of a mid-tier CEO, I mean, what was that flood of cash? What's it done for the M&A market? Has it kind of created a paradox where high gold prices actually make it harder for growth companies to find value accretive deals because you're now competing with giants who have more cash?
Well, it makes things more competitive just from a cost of capital perspective for most of the mining companies that are out there. Obviously, we went through a period where equity was a very expensive way for them to advance the assets and put them in production and working cap and so forth. And so royalties made a lot of sense during that period of time. As we kind of look forward, what's happened, generally with the royalty sector in itself. I mean, we saw the royalty sector as a whole add $30+ billion in market cap over the last kind of 18, 20 months or so. So significant increase in market cap, significant increase in free cash generation for the sector. But the opportunity set did not double in size along with it. So it did make things a bit more competitive from that perspective. And I think that's driving a lot of the consolidation. You've seen that over the last couple of years on kind of the smaller end part of the sector. But, we just started to see that within the mid-tiers and the majors with the Royal Sandstorm transaction. And I think that that trend is going to continue.
Yeah. I mean, it sounds like, as you mentioned, that race to either scale up or get acquired, that consolidation between Royal Gold and Sandstorm. I mean, for a company in your position looking to grow, where was that capital supposed to come from? Was it the traditional financial market, equity raises, bank debt, becoming too difficult or too dilutive to kind of compete in this new high stakes environment?
Well, cost of capital for royalty companies usually is relatively competitive, and I would say that where the sector has gone is for mining companies specifically looking to take on capital via royalty or stream. It's become pretty competitive. I would say even with these elevated equity valuations kind of across the sector, just given the competitive nature of that. Now, I say that. In regards to kind of high quality operators, good jurisdictions, great assets, obviously, as you kind of go further down the risk curve, things become more attractively priced, obviously, to price that higher level of risk.
We've been chatting about it a little bit, but of course, it's almost stunned the mining world. I mean, Tether, of course, the issuer of the world's largest stablecoin, has made a series of aggressive moves into the royalty space, including taking a significant stake in your company. I mean, it's not a passive investment. They've also taken an 8.1% stake in Gold Royalty Corp, a controlling stake in Elemental Altus. Traditional mining world is famously conservative, Brett. And I'm wondering here what this partnership looks like and how exciting it is.
Well, I think it's always great to see disruptive capital come into the mining sector. However it shows up, really, I think that it creates kind of a bit of more of a competitive environment for the traditional businesses and also sources of capital. And I don't think that they are the last ones to enter the sector. I think that they're the first. They're obviously being very, very aggressive, already kind of consolidating two of my peer companies, and also taking a position. I can't comment on obviously what their intent is, but I think that they see the value in these royalty assets. I mean, these royalty assets can allow really the reserve of the ounces in the ground while having that yield. It's kind of the U.S. Treasury of the gold market, and I think that's what's drawing to them to the sector.
Yeah, let's talk about the sheer scale of this, because I don't really think that the market fully grasps it, because according to that analysis in the industry, Tether generates over $5 billion in annual cash flow. To put that into perspective for our audience, that's 5 times the revenue of Franco-Nevada, and most valuable company in the sector. What does it mean practically to have a partner with a fire hose of capital like that? Does it fundamentally change the types of deals that the entire mid-tier sector can now kind of consider?
Well, I think it changes the way a lot of the companies kind of view M&A,
Yeah.
within the sector, because I think that now there's this new player that has a different objective altogether, a different view of value, it seems, at least, and they're aggressive. So it's starting to really make some of the existing players within the sector kind of think about the assets that are out there, and kind of what's available, and how strategic they are. So it's, again, I think it's always a good thing to have disruptive capital come into a sector. And again, I don't think it's the only one. Mm-hmm. I am a little, I do understand why they're being so aggressive, because, I think that they are, the core business is exposed to the front end of the curve. And it looks like we are going to see interest rates substantially lower by this time next year.
I got to ask you, Tether CEO has called gold nature's Bitcoin, suggesting that deep, philosophical kind of alignment. Do you see this as the beginning of a great convergence, a bridge being built between those two investor classes, the crypto guys, the hard assets, that kind of share that similar anti-fiat, anti-central bank worldview? Could this unlock a whole new investor base for the entire resource industry?
Jeremy, I think it's way, way bigger than that.
Yeah.
A trend that I've been following here for the last couple of years is really this transition of gold becoming the tier 1 reserve asset globally, and it's well on its way there. That trend has continued to move forward at full speed. If you look at the Q3 central bank numbers that just came out yesterday, and we saw a record amount of tons. I think it was 1,313 tons, but it increased 44% year over year in the dollar amount. So significant amount of buying. But what is this? It's obviously price insensitive buying, because you're getting gold going at all-time highs. You're getting this type of physical demand across the sector. It's a transition away from U.S. Treasuries. And so this is happening. It's continued to happen. And now U.S. Treasuries, gold makes up a greater amount of total reserves as compared to U.S. Treasuries by itself. You still have U.S. denominated assets as a whole making up a larger portion of gold. But I think this is going to continue until gold makes up probably 50+% of global reserves, and gold's going to need to go to probably $6,000 to $8,000 an ounce in order for it to do that. And that's just some simple math. But what's interesting is now that I've been watching this trend for the last couple of years, you can kind of see it. It is way, way bigger than just the transition of the world's view of U.S. Treasuries being a reserve asset. What we're seeing, and what I believe that we're seeing right now, is really the early stages of what I call kind of the great rebalance. You've got $370 trillion of financial assets, and that is transitioning to tangible assets. I think that's kind of the bigger trend. And we live in a world today where there are no more bond vigilantes. And so, where is this inflation? Where is this, call it, monetary debasement trend showing up? Well, it's showing up in gold. And as a U.S. citizen, like, you look at everything in your own currency, and other countries kind of vice versa. But in reality, when you look at kind of this broader trend, I think that it's showing up with gold now, but it's going to be going into all other tangible assets. I think copper is another one, but commodities in general, tangible assets across the board. You look at kind of the performance of the broad stock exchanges and so forth. Like, you kind of see this, and you're like, okay, well, this is a much bigger trend. We're at the beginning stages of it, and I think it's going to continue here.
Yeah, are you seeing? You're talking to investors all the time. You're getting some insight from those institutional level participants too. Are you seeing fresh participation from family offices, sovereign funds? More retail capital chasing these real assets again?
Yeah, so this is the part that just absolutely boggles my mind. The last 30 days, I spoke to some of the largest asset managers on the planet across North America and Europe. And when I'm going into these meetings, typically I'm talking to the resource PM. They are pulling in the generalist PMs in all of these meetings. And it's the generalist PMs that are thinking and asking all the questions about how to get positions, how to think about allocating capital to this sector, even starting it in the form of just physical, like not even really scraping the surface with mining equities. I can say, and I've confirmed this with a couple other executives at some of the largest gold mining companies in the world, and they're seeing kind of the same thing. So what does that tell me? That tells me that the generalist capital flows have not even started yet. They have been so preoccupied with the AI trade and just in general that they have not even started to think about this. They have been waiting for this pullback. I think this pullback is really the start of when we start to see the generalist participation. If you look at the fund flows on the GDX, which is called the largest gold mining ETF for the large gold mining companies, the week of October 20th was one of the largest inflow weeks. And keep in mind, this is when gold had a 10% correction, so the equities were way off. Mm-hmm. And I think it was the top 2 or 3 largest weeks in the last 5 years of the GDX. So far, right now, October as a whole is, I think, the third largest inflow in the last 5 years from a monthly perspective. So what that tells me is that all of that generalist capital has been waiting on the sidelines. It tells me that this correction that we're in right now is probably not going to be as deep as I think some people are probably hoping for, and it'll probably be a lot quicker as well.
Yeah. So you're describing those strong inflows and that new investor stepping in. Did that last sell-off that we were talking about, it stabilized? $4,002 on the spot side. Did it actually help the market? Did it shake out the leveraged players and short-term traders, kind of clearing the way for more patient capital to come in?
It did, and that's a healthy thing for bull markets. This has been one of the most ignored bull markets I've ever recognized or seen in my career so far. To see gold go to $4,000 an ounce before kind of the generalist asset managers just start to wake up is just mind-boggling. But they are woken up. We are kind of in I would say, this awareness phase. If you look at kind of market psychology of bull markets, there's always this kind of awareness phase. It seems that we're kind of in the middle of that awareness phase at some point in time, but we have not even started the mania phase. The mania phase is typically when you get all of those capital flows coming in. We have not seen that. You look at the Dow to gold ratio, and that's the other thing to kind of keep in mind. You got to put it in perspective, because looking at everything on a US dollar basis in the midst of this great debasement, it can fool you. It can really tell you a different story. So it's important to look at the ratios. And when you look at the Dow to gold ratio, that peaked in the last bull market around 6, meaning that six ounces of gold basically equaled the Dow. That was in 2011. Historically, that has gone to 1-to-1 in the past, but we're still sitting around 11 right now. When you look at the XAU, which is one of the longest kind of standing gold indexes, versus gold. So basically, these gold stocks priced in gold, like we're just barely off the bottom still today, even with these substantial moves. So I would argue that that there still is a long way to go in this bull market. And I think that, again, the corrections are going to be shallow to the point where a lot of investors are going to miss them altogether.
Yeah, you've been watching, obviously, some of the miners, too, on that equity side. We saw gold and silver take that little bit of a haircut, and so did some of those stocks. But it's been, a lot of people have been buying the dip here. I mean, what are your thoughts? I mean, it feels like these gold prices and revenue is just starting to come to fruition. It doesn't feel like it's going to stop for a while.
Well, look at the bid underneath gold, and then you look at oil. Oil is pretty contained. I think that will move at some point. We are hearing inflation start to creep in a bit more on the labor side of the equation. I mean, when you look at the mining companies in general, like over the last 30 years, the margin has always reverted back to the mean. It's been like 30 to 35%. This is a consistent margin that the sector, on average, has always migrated back to. Now, there's some great businesses with much higher margins, but I'm just saying the average in general. The average today is double what or even more than double what the average has been over the last 30 years. So when you look at it from a mining, company perspective, I think that those margins, if gold holds and goes higher, can remain elevated for a much, much longer period of time. But eventually, I do think that the costs creep in. And that's why owning royalties is such a great way to play it, because you get 100% of that margin expansion without the CapEx, without the dilution, without the operating costs and so forth, and you get to capture all of that all the way up, and you don't have to pay for it because it's free carried.
We're also seeing a global trend towards the tokenization of real world assets. I know you've heard about this. I mean, BlackRock's Larry Fink says all financial assets will eventually be tokenized. Obviously, Tether is a leader in that space. Is the next logical step here to tokenize the tokenization of mining royalties themselves? Could a crypto investor one day buy a digital token representing a fractional interest of one of your royalties, giving them a direct yield-bearing exposure to a tier 1 gold project on the blockchain?
I think that royalties are the best, call it asset within the entire resource industry to kind of serve that function for sure. Mm-hmm. You can't, it's very, very difficult to collateralize gold in the ground without it having the ability to come out. Mm-hmm. And in the royalty business, like you own a 1% claim on whatever's in the ground. And if Agnico Eagle or Barrick or Newmont are operating the mine, well, guess what? That gold's going to come out of the ground. It's completely free carried, and it's going to be not only delivered to you top line, but it compounds. So it's the ultimate kind of holy grail for thinking about digitizing an asset in this industry. I think it's kind of, again, I think it's probably from a structure perspective, the best fit. And I think that's probably why, institutions like Tether are attracted to these types of assets.
How do you manage the two worlds? I mean, how do you communicate all this? Because you get two completely different investor audiences. You got that traditional mining investor kind of focused on discounted cash flow, jurisdictional risk. And now you have this crypto native investor driven by, network effects and macro themes like de-dollarization. I mean, how do you as a CEO bridge those worlds? How do you communicate your company's value proposition to two audiences and, attract in those investors?
Well, really, we just focus on our business. I mean, we built this business to play or to have our investors have the ability to kind of maximize this trend. And we spent, upwards of 9 years deploying $309 million across 100 assets. Now, we deployed $309 million, all of which when gold was under $2,000 an ounce. So the amount of leverage that's embedded and the optionality that's embedded in these portfolios is very, very significant. And the mining sector hasn't even begun to start thinking about planning or mine planning at even above $2,000 gold. I mean, you're still seeing most mines being planned sub $2,000 gold. And as these mining companies start to get, or these executives at these mining companies and these boards start to get a little bit more comfortable with gold where it's at and that it's not going to come back down, because again, if you look at kind of how these mining companies are priced right now, like they're priced at a much, much, much lower gold price, which is reflecting the value. But as they start to think about planning at a $2,200 gold price, what does that do to ultimately to the reserves and the resources? I mean, it significantly has an impact on how they look at that. You're going to see very, very large expansions, and the royalties cover all of that. Like the royalty covers all of that upside. I think we're at the beginning of this cycle right now. I think it's going to take probably, I mean, I'm hearing right now a lot of executives in their budget meetings for 2026, their heads are just absolutely spinning because they just don't know what price to use and how to plan for these assets going forward, just given that the volatility has been so extreme over the last 18 months. And then the sector has been burned in the past by getting too aggressive. So I would say generally the sector has been very, very conservative, but there is enormous amounts of optionality and kind of embedded value that just is not even remotely close to kind of surfacing within these markets right now.
Yeah, and I mean, to your point now, I mean, if you got you're at the forefront of this convergence between gold and this digital capital. I mean, if you get these new investors in, what does resource finance look like 5 years from now? I mean, do we see a wave of M&A driven by new liquidity and then the permanent kind of re-rating for mid-tier royalty companies willing to embrace it? What are your thoughts?
Yeah, that's a difficult question right there. I don't know what it's going to look like within 5 years. I mean, when we built Metalla, the royalty sector is all about playing the cycles. And so we focused on very, very high quality, long duration type of assets. Now, that wasn't always in favor in regards to kind of what the market was delivering or kind of giving value for in the public markets. But having access to very high quality, long-term, I'm talking 20 plus year reserve life assets, allow you through these cycles, through these up cycles, to basically be able to kind of sit back if you need to, and allow all of that embedded optionality to play out, allow your shareholders and investors to reap all of those gains. But if you don't have that type of duration within your portfolio, then you're in trouble because you're on this kind of never-ending hamster wheel of trying to redeploy capital at higher and higher prices, typically with lower and lower quality assets. And so, our business, I feel, is in a pretty good position right now. And since we have that duration, like I said, our top 10 assets average reserve life is 20 years, and that's the highest amongst our peer group and even the mid-tiers as well. And we have that duration. We have the strong counterparties. We got the good jurisdictions, and owning the gold in the ground, I think, in these jurisdictions is the safest way to do it.
Yeah, when the capital comes flooding in on this M&A cycle, I have to ask, because of course you're inside of this, right? I mean, you see it. I mean, how do you keep bidding wars and overpaying from repeating the same mistakes that we've seen in those past cycles?
It's difficult. It's very, very difficult because there's always going to be a company that feels like they need to redeploy some of the cash. I mean, like we talked about earlier, like the free cash is just completely, increased at a rate that most of these companies, had never even dreamed about. And so how do they think about reallocating this capital? Well, they're doing the smart thing right now, which is they're strengthening their balance sheets. They're paying some dividends and some stock buybacks, but I mean, maybe another 6 to 12 months of that, they're not going to really have much to do. I mean, they're building some very, very big cash positions today. Generally, across the sector. So it's a difficult thing because there'll always be one company that wants to use, call it a more aggressive gold price in order to kind of justify whatever price they need to pay to clear the asset acquisition. So it's good to be in businesses that don't have that pressure. And so, yeah, very, very high quality companies with great pipelines that are already bought and paid for is kind of the key thing, I think, to look out for in this market.
Yeah, good advice on that one. I was going to ask, because for investors watching, I mean, should they focus on the disciplined acquirers who kind of sit out those overheated deals, or on the aggressive players using this window to scale up as fast as they can?
Well, I think there's times to be aggressive. Yeah. So over the last 8 years, before gold kind of started this big move, that was a time to be very, very aggressive. And so you saw some big mining companies be aggressive, like Agnico Eagle and some others that made a lot of, call it, more aggressive acquisitions at the time that I think the market looked at. But when you look back on it today, these transactions are the returns are absolutely phenomenal at today's gold price, and same with Metallas. But we did 32 different transactions over 8 years, and we haven't done one in the last 18 months. So I think we're in a different market now where it's difficult to get aggressive because, again, like the volatility, the gold price, kind of the lack of kind of higher quality assets. I mean, there are a lot of different things coming to market because I think the price is driving a lot of sellers to, call it, cash in on kind of what they feel is a great option in bull market. But yeah, the valuations across the board are kind of a difficult thing to manage.
Yeah, fascinating too about the Tether news. I mean, is this the future? None of this surprise you? Is it just getting started? Are you here? What insight can you give us into that?
Well, I think that we're going to see more of it. I think we're going to see this manifest across a number of different type of institutions around the world. There's only so much physical gold out there, and physical gold is a massive market. Obviously, we see what's driving that, but at some point in time, the world is going to say, okay, how much more physical do we buy at these prices, and what are other means to get exposure to this metal? And I think that is going to bring in a lot more disruptive capital. I think groups like Tether are at the forefront of that, and I think they're doing a great job trying to maximize that value. But I do think that there's more to come in probably the near term as well.
Yeah, fascinating to watch. All right, it's reshaping the way money flows into mining, that's for sure. Brett, he's CEO of Metalla Royalty and Streaming. Fascinating conversation, and one we'll be tracking closely as this story continues to develop. I appreciate this, Brett.
Thanks, Jeremy. Thanks for having me on.
Thank you so much. All right, I'm Jeremy Saffron. You're watching Kitco News. We're going to have more all week long, so be sure to hit the subscribe button. Stay tuned, and we'll be right back.